Let's bring in James Athey now, Senior Investment Manager, Aberdeen Standard, to weigh into the conversation. James, great to have you on Street Signs once again. Just speaking to Athey there, who's been in Frankfurt covering the banking summit taking place. She spoke to one of the ECB members. And there's this interesting question now of whether we see policy divergence emerge among the different central banks, the ECB, the Fed, the Bank of England. What do you think in terms of that question? Are we likely to see significant divergence in the policy path of these major central banks in the year ahead?
Morning, Juliana. Good to be here. Yes and no, I think, is the answer to that. The ECB really does sort of sit in a group of one. There's specific issues which the central bank faces, just given the nature of the region. Athey in that previous piece touched on it. This is not an optimal currency area. It's a poorly constructed and partial monetary union, and that creates a whole special set of problems which the ECB has been tasked almost single-handedly with dealing with. So they sit in a group of one. The ability for them to tighten policy to any degree is materially less than the other central banks. I think the question about the spread between the other global central banks is a really interesting one. I don't think any of us know the answer just yet. There's going to be a lot of toing and froing in terms of the policy path, the sequencing potentially of policy unwinds, and of course the pace at which those central banks can go.
Well, there was obviously a lot of attention on the last Federal Reserve policy meeting. Do you think that was a game changer in terms of the way the Fed is thinking about the policy path moving forward, or was it simply a little bit more insight into what they had already said to the market?
Yeah, I'm definitely more in the latter camp. Game changer, it potentially could be a game changer for the way that financial markets are going to imbibe new incoming economic information. But I think the market's kind of got it wrong, really. This interpretation of a reaction function shift, even a reaction function change relative to what the market was working with, I just don't think we had sufficient information, because that's not how the dots can be interpreted. Each dot is an individual's economic forecasts, and then a rate forecast contingent on those economic forecasts. So you can't compare dot to dot without understanding the underlying forecast. So I think the market's interpretation there is incorrect, but potentially going forward it does mean that the market is more sensitive to upside and downside data surprises in areas of the treasury market which previously were quite low beta. So front end treasuries, 5-year treasuries in particular, and real yields as well. Tips, if tips are leading sell-offs, that's a materially different environment. Tighter brakes, stronger dollar, probably a big headwind for risk. So if the market continues with its current emerging, shall we say, interpretation, I do think the market's dynamics will be different going forward.